welcome everyone to the September meeting of Left Field Investors. Just to make sure, can everyone hear me? Maybe just give me a thumbs up if you can. All right, perfect. Thanks for being here. We missed you last month, and I missed a couple of meetings in the summer, so a lot of new faces, which is fantastic. A couple of things I just want to go over real quick. Our next meeting is October 25th with Jameson Lett, who is somewhere here. Give a wave, Jameson. Yeah, he's going to be talking about the cash value life insurance program and how that can help investors. He spoke about a year ago, but that was when we were a much smaller group, and we've had a lot of talks in the Infielders Forum about life insurance and cash value and how you can use that to kind of juice your returns. So Jameson will be covering that next month. Also, for those of you that are Infielder members, we're having a meeting next Monday, the 4th of October. Can't believe it's October almost already, with Ian Kurth. Ian is one of the smartest, most detailed investors that I know, and he has recently dug deep into Bitcoin. So I'm really excited to hear what he has to say about Bitcoin. His attention to detail is amazing, and he's going to give us a great presentation. And then a couple of items just about our group. You know, we are trying to grow our group. We did have a referral program. We sent out an email asking people to refer their friends. Some promotions work, some don't. So there won't be a drawing today because we did not get any referrals from this. But as I always say, you know, this group, we're all about learning and figuring it out. And none of the group that, you know, none of the people that lead this group are professional, you know, community builders or group leaders or anything like that. We're all investors. So we're throwing some stuff against the wall, and some of it works and some of it doesn't. So thank you for your patience on that. One way, you know, we're trying to grow the group slowly, but with intention. And we want quality people. And so far, our group is just filled with people that, you know, are really smart investors. And I've learned so much from you guys. So I appreciate that. We want to keep growing it with like-minded people that are interested in, you know, creating wealth through investing in syndication. So if you know some people that might be interested, please share it. Another way we can grow our group is if you're a podcast listener and you listen to the Passive Investing from Left Field podcast, we'd really appreciate you to download the podcast every week and a 5-star review. I know people get tired of people asking for that, but it'd be awesome if you could do that. If you don't like the podcast, a review is not necessary. Couple quick updates on the Infielder tools. We're about to launch the user profile, which will hopefully help with our networking, meaning that you can click on somebody's name and you'll be able to see some information about them and their email. And because, you know, I get to network with a lot of you because I do the phone calls and I meet a lot of you, but I want everyone else to be connected. And so after this meeting, we'll do Zoom rooms. Well, each of you will be in a different room and we'll try to do some networking there. But ideally, we'd like to have people having individual conversations as well. We also have the sponsor overview, which hopefully will be released soon. It's an Excel tool that basically has a lot of our sponsors that we're aware of and has just some information on them. Basically, you know, what markets they're in, what asset class, the minimums. Do they give left field investors a lower minimum? Because some of them do. Maybe how many left fielders are already investing with them, and then just some other the fees and other things like that. So it's just kind of a deeper dive into different sponsors. And then our portfolio tracker is up. It is not perfect, and we're going through the final corrections and versions of phase 1, and then we'll go right into phase 2 and start making improvements. So with any of these tools, if you use them and you have feedback, I would love to hear from you because we're always trying to improve them. And then hopefully by early next year, we'll have our sponsor review tool out, which will be kind of like an Amazon reviews or a Yelp for sponsors, where we'll have you can give them stars and rate them in different categories, and then do a little write-up about them just to help our members find more quality sponsors. Real quick, I want to go into the Cohen Estre deal that I emailed out. This is a unique deal. Unfortunately, it's just for accredited investors only, no way around that, but it allows us to invest alongside a family office. And this is a large family office that you know, buys these institutional assets, and they put it 90% of the equity, and then the fund that Cohen Estre does puts up 10%. And the minimum is $200,000. And when I was talking to the principals, I said, $200,000 is more than I want to put in one fund or one sponsor right now. I may do that in the future, but right now I'm going for minimums. And they suggested, why don't you see if you can get a group of left field investors together and see if we could go in together. And so that's what we're planning on doing. We have about 40 of you who have expressed interest. So we could raise quite a bit of capital. And if you express interest, that's all it is. You're committed to absolutely nothing. So if that's something of interest to you, send me an email. I'm going to start trying to figure out when we can get on a Zoom call to talk to them and have them make a presentation to you. So that's coming up. And just so you know, Cohen Esray was referred to me. I only like to invest now with sponsors that are referred to me by somebody that I know, like, and trust. And they were referred to me by a very sophisticated and diligent infielder. So I have a lot of faith in this company, and this person has already invested with them in 2 different deals. So I think they're really a top-notch group, it seems like to me. So with that, I will move on to actually the reason that we're here, and that is to introduce Ryan Gibson. He is the Chief Investment Officer and the co-founder of Spartan Investment Group, which is self-storage is their main focus. And Ryan is responsible for investor relations, and he does the capital raises for the projects. He's coordinated over 90 million in private capital for projects so far, and I'm sure that's increasing every time I talk to him. They've grown to 50 plus full-time employees with over 250 million in projects under management. And in 2020, Inc. magazine recognized them as the 8th fastest growing private real estate company in the United States. Just for full disclosure, I'm in 2 of their deals. One of them is performing great. The other is new, so it's just starting. So it will also perform great, I'm confident. There's a lot of deals that Ryan is working on now, and we appreciate his partnership, and we thank him for coming on. So Ryan, I'll kick it over to you.
Jim, thank you so much for having me, and what a great group. I really appreciate you guys having me on to talk about self-storage. But the reason why we got into self-storage was got it on mute here by mistake, was because of this. This is why we got into self-storage, because we don't like people. No, we love people, but we didn't like tenants and apartments getting trashed and my single family homes getting trashed. We also didn't like this, which played out in COVID, where people couldn't raise their rents, people couldn't evict. I think Governor Inslee here in Washington has extended it another month. But we love storage because there's no tenant, or there's no toilets. We have about 12,000 units, and we have about maybe 50 toilets. Jim, in your deal, there's about 2,500 units or so, and I think there's about 4 total. We don't have any leasing agents. We don't have any appliances. We don't have water heaters. We don't have eviction problems, and we don't have all of the problems that you get from tenant turnover. We've also enjoyed 12.7% annual rent increases during COVID. So when a lot of moratoriums came out, we had the pleasure of seeing self-storage perform exceptionally well during the COVID time. Specifically, 12.7%, as I said, nationwide. We're heavily invested in Dallas, Fort Worth, where rents were up 12% year over year. That's June 2020 to June 2021. We're in Atlanta, Jim, that's the Southeast portfolio. Primarily, we have 5 assets in the Atlanta metro area. They saw year over year growth at 19%. And then we're in the Seattle market, south of Seattle. We saw rents go about 5%. And, some people say, well, geez, during COVID, why, or just in general, why do people use storage? And it's really simple. It's all about life events. So, right now, I've actually got my stuff in a storage unit because I have a 2-year-old son and a 5-year-old daughter, and we have a growing family. And I just opened up the back of my house, and I'm going back and adding on another bedroom and doing a renovation in my basement. So I've got all of my stuff moved out of my house downstairs and put into storage because I had a life event. And when I was actually flying during COVID, and I saw one person in the terminal, and I went up to them just because it was kind of a camaraderie at that point. What are you doing in the terminal? No one's here flying. and they said, oh, I'm flying to Florida to put my mom's belongings in storage because she just passed away. So a lot of life events trigger self-storage. So when you have a lot of disruption in the economy, you see a lot of storage events. And so during earlier this year in the spring, we actually had some of the highest rental increases and the highest occupancy rates that we've seen in the industry, because storage is really just kind of an uncorrelated asset class type. What's interesting is that 1 in every 10 Americans uses a self-storage unit. Specifically, 67% of the people who use storage have a garage. So there's a lot of business uses. I'd say about 40% of our customers are actually business owners, such as staging companies, et cetera. And so because the industry has really matured, unfortunately, a lot of big institutional groups have noticed. So for example, Blackstone in Q4 of last year bought Simply Self Storage for $1.2 billion because they really wanted to be in the space. But the kits just kept coming. So Bill Gates just bought largest share of StoreMart, which is one of the largest operators of self-storage in the United States. And then most recently, just earlier this year, Public Storage bought Easy Storage for $1.8 billion, which when you do the math, it worked out to about $480 a square foot for the transaction. So pretty significant. What's interesting about storage is if you took every single Starbucks location in the United States and added them all up, you would still have more self-storage facilities, even after combining McDonald's, even after combining all the Burger Kings combined. And in fact, if you looked at all the self-storage facilities in the United States and compared it to all the fast food restaurants, you'd still have more self-storage facilities in the United States. So they're becoming very commonplace, wherever you go. Specifically, it's a $39 billion industry. There's just under 2 billion square feet to rent in the United States. There's about 60,000, as I said. And there's about 5.4 square feet used for every average American. So let's just say there was 10, call it 100 people on this call. And that would mean that there was a 540 square foot demand on this call. So I can't really see everybody, but show of hands, how many people have used self-storage, me being one of them. I'm using about, I don't know, maybe 150 square feet right now. And that would be the average in the United States. Now, in certain markets, self-storage utilization goes up. So in Texas, as an example, we see some places where they're doing 20 square feet per person. And that's mostly because there's no basements in Texas, and there's also the attics are very humid. So a lot of people need self-storage and need that extra space. So about 10% of households, like I said earlier, and then our average rent's about $90 a month. So just kind of like why we got into it, this chart here, as you can see at the bottom right, it only goes to 2016. And this is when we started looking at storage. We studied some data from Marcus and Millichap, Nareit, and Standards & Poor's, and we saw that the self-storage REITs were outperforming the S&P and all other REITs by over 300%. So this is during a good time. This is during a time where the economy was expanding. So we're like, wow, it's just absolutely crushing it right now. But what we couldn't help but notice is that during the last 2 downturns, it was actually the least foreclosed upon asset class. So it's, the only other asset class that performed better during the last 2 downturns was medical office, because that's really something that doesn't go anywhere. So how does it compare? I know a lot of folks here are invested in multifamily, me being one of them. I invest in multifamily and other types of asset classes. And what we like about real estate is that it's all very tax advantaged. And so self-storage really isn't any different. We still get bonus depreciation and cost segregation. The average stays are pretty comparable. Our average stay in our portfolio right now is about 48 months. So it really is sticky. We're on a month-to-month lease, but everybody's sticking around for years for the most part. Economies of scale are pretty good. Obviously, in single-family flips, it gets a little bit hard. But where storage kind of pulls away is the automation, the rent recapture, and the low maintenance. So automation, somebody can just go on our website 24 hours a day, 7 days a week, and book a unit, pay, sign a lease. They get a gate code, and they can get right into the facility without having to talk to anybody. The other thing that we can do, when the tenant doesn't pay, we can switch off their gate code automatically within the gate software. and they're locked out after 5 days. So if non-payment after 5 days, they can't get into their unit. And lastly, the second thing, the rent recapture. So what is that? So imagine the first line in your lease says, if the owner reserves the right to lien the occupant's belongings after non-payment of 30 days. So if we do not receive payment for 30 days on a tenant or an occupant in self-storage, we can actually lien their belongings and we can then auction them all off. So if you can imagine, after 5 days, you're completely locked out of the property and you can't access your goods. And then after 30 days, we can actually sell all your stuff and take the profit from that sale and use that to back pay all of our rent. So, any rent that you owed us or admin fees or late fees or whatever, anything on top of that is profit that just goes to the occupant. And then low maintenance. We don't have the appliances, the kitchens, the flooring, the paint, the turnover, all the things that go into self-storage. So a little bit about Spartan. I know that Jim gave us a nice intro. We're actually based in Golden, Colorado. We have a satellite office here in Seattle. And we're the fifth fastest growing real estate company in 2021. We just got the ranking by Inc. 500 and the 166th fastest growing all. And next year should be pretty interesting. We might rise a little bit higher on that list. And out of all the self-storage operators in the United States, we're about the 90th largest operator of self-storage in the US. And we operate everything under the Free Up Storage national brand. So you can see the Free Up Storage logo there. We try to brand all of our properties in that kind of same branding, which is what Simply Self Storage did before they got acquired by Blackstone. So where we started, this is kind of a fun story. Scott and I actually started the company, and that house in the middle is actually the first house that we flipped that's in our nation's capital in Washington, D.C. And the White House on the left side of that house in the middle, I actually lived in. I have a former career as an airline pilot. That's me in the flight deck of an Alaska Airlines 737 with my daughter on our way to Hawaii on our first flight. And then Scott moved into the house to the right of the house in the center. And Scott has a former military, or has a military background. He's a Army vet that served in Iraqi freedom and still serves in the Guard. He's on a very difficult mission there in Hawaii, as looking out the helicopter there in that picture. So, but yeah, we met as neighbors in Washington, D.C. and we kind of became friends, and we said, hey, let's figure out how to flip this house in between us. And that's how Spartan started. We actually ended up flipping 4 houses on this block. And then we just wanted to really pick an asset class that performed well. One thing that Scott and I really kind of have a good alignment on, Scott being in the military and me being an airline pilot, really strong checklist driven approach to everything we do, but we're very big on our values, which are defined by our grit. And so our grit is growth, respect, and integrity, tenacity, and transparency. So that's kind of some of the values that we put in everything that we do. And our current portfolio, we have about 12,000 units, about 65 employees now. That number is growing by the week. 340 million under assets under management. We have about 400 active investors. You're right, Jim. That number's increased to about 120 million since we last spoke. And we have about 10 completed projects that have gone full cycle, meaning we bought the project, operated it, and then disposed of it. At Spartan, we like to do everything. We like to do we build our own units. We do our own renovations. We're our own general contractor. We acquire the property. We find the debt through our capital markets team. We raise capital from our investors. Like I said, we do all the construction, and then we do the asset and property management. So we're directly hiring everybody at the property level. And this is kind of a look at our portfolio today. These are all of our self-storage facilities around the United States. We're going to add quite a few to this in about a week. We're adding another one in Colorado's Western Slope, and then we're adding 18 in and around surrounding Dallas-Fort Worth. So likely we'll be actually moving up to probably the 30th or maybe the 40th largest operator of self-storage in the United States. So you might ask, how do you add value to a self-storage unit, when it's just a box with some walls and a roof? And the first thing that we do is we really try to find mom and pop owners that have a low cost basis, that really have never pushed rents, never pushed marketing. Maybe they've owned the property for 25 or 30 years, and we have the opportunity to raise rents. And here's kind of a very simple example of what we do. Let's just say that a tenant's paying $30 a month for a unit. But we might actually go in that market and find out that a competitor is charging as much as $80 a unit. And I know it sounds ridiculous, but a lot of these units, a lot of these owners are defining their success as being full or 100% occupied and not necessarily optimized to the market. So when we come over, we may take over the property and we may raise rents to $50 a month. And really at that point, the tenant has a couple of different options. A, they're going to call the competitors and find out that they're all $80 a month and realize that, okay, maybe I still have a pretty good deal. I'm not going to move. B, they're going to decide, I really don't need my storage unit anymore. Or C, they're not even going to really notice. They're just going to keep paying and keep staying in the facility. Usually when they leave, it actually gives us a pretty good opportunity because we'll come in and actually the new tenant will pay $80 a month. So turnover is kind of our strategy. When we take over a new property, we like, only about 6 to 7% of our tenants move out when we raise rents. But when they move out, it's actually a nice opportunity because instead of kind of slowly boiling the frog to $50 a month, we can actually get a new tenant in at 80 with the good marketing that we have. But other ways that we add value, all of our tenants are required to have insurance. They don't have to buy our insurance, but if they do, we have a preferred vendor and we get about 50 to 60% of the revenue for every single unit on the tenant insurance that is purchased through our provider. We sell merchandise. So on the Tyler Longview portfolio and all of our properties, we add in a retail store where we have boxes and packing goods and things like that make it convenient for the customer. On any excess land, we'll build boat and RV storage. We do the storage auctions. We have PO boxes. We have notary services, FedEx, UPS drop. This is our storage facility down in Black Diamond, Washington, just south of Seattle. We have a free moving van that we offer for tenants that rent for the first time and move in. And then we can actually rent out the truck for a profit. And additionally, we also have U-Haul truck rental businesses. And the way that U-Haul works is we essentially get a ground lease and it's a revenue share of the profit. And this one is a cell phone tower. Jim, the Tyler Longview portfolio actually has a cell phone tower at one of the facilities, and it's a triple net lease. So we get the income for basically doing nothing, just having this thing on our property. This is not the actual one, but sometimes you always see them as palm trees and things like that. And we actually put all of our storage facilities on the land registry, so that cell phone companies know that they can approach us and potentially put a tower on our property as an ancillary revenue. I can't remember how many we have, but maybe 3 or 4 in the portfolio currently. So, kind of what's a typical project? We really like value add and we like ground up. So probably 95% of what we do is this value add right here, where you can see this comes with about 11 buildings. And then there's that big orange box where we put in additional units. We'll do things like improve operations and we throw our brand standards on everything we do. So I'm going to show just a quick video on this project. This is Mini West Self-Storage in Texas. It was about 750 units when we purchased it. Indoor storage, climate control, and had some outdoor. And we took that land right there and we put 2 buildings on it. And this is kind of a fun construction camera. This is us actually time-lapsing the construction of those additional units. So it's about 40,000 square feet. And currently we've leased up those buildings now, 80%. We do a little fun celebration with the Chamber of Commerce when we build our stuff. And again, these are the indoor units we built. And then these are some of the outdoor units. And we find that our tenants like that mix of having some drive-up units and then also some indoor climate control units as well. This is really fun. This is one of our development projects. This is actually a project that we took what we call trees to keys. So we bought this land off the State Route 169, just south of Seattle. We got all the entitlements. We moved the wetlands. We worked with the Army Corps of Engineers, the Department of Ecology. We got the zoning approved, our site plan approved, all the things that went into getting the project fully entitled. Took us about 4 years. And we did raw land development. And this is the facility that we built. We changed the color at this facility when we got our brand standards, but this is kind of a fun video. This is the project right here. This is 5 acres of vacant land just south of Seattle, and you can see it there. And this is when we graded it. It was quite a big project, and that's it today. So this is right off the state route, just south of Maple Valley. And this facility opened up in June of this year. So, talking about, sort of, if you're looking to buy self-storage yourself or investing in it, you really want to have a good team to do it. And the 4 gentlemen here on the right-hand side are our acquisitions team. They do full-time acquisitions for Spartan. So they go out in the market, they call sellers, they letter, they talk to brokers. We actually have a relationship with the top self-storage brokers in the United States, and they're constantly bringing us great opportunities before they even hit the market. Or sometimes they often steer opportunities our way, which is how we got the Tyler Longview portfolio. But just some stats, we look at about 1,200 deals a year. Last year in 2020, we put out about 24 offers and we closed on 9 facilities. So we look at a lot. There's a lot of stuff on the market. There's a lot of stuff that comes available that just don't meet our criteria, or that we have to, that don't meet our demand study. And, speaking of demand study, we do have a team that looks at the things that go into a property that makes it have great demand, such as population trends, saturation, pipeline, and net migration of jobs, and really importantly, rental rates. You want to make sure that you have a complete study done on every property that you're going to buy. These are some of the markets that we look in. The highlighted colors here around the United States. We focus on about 150 markets that have good net migration of population, that have favorable rental rates for self-storage expansion, have good demand, and overall just good income and population growth. And we've kind of narrowed down the entire United States to specific markets that we'll take a deal in. This is our operations team. They handle all the hiring and the operations at our property level. And I just wanted to give a quick snapshot of the underwriting file, just typical things that make up revenue on the left-hand side, and typical things that you'd see in a self-storage underwriting file for expenses. So I wanted to go through just really quickly, just an actual property that we purchased last year. And there was 2 properties actually right there in Longview, Texas, Metro and Gilmer Road, that we bought in Longview, Texas, and 2 properties that we bought in Tyler, Texas, Highway 155 in the Attic. And this portfolio was purchased for about $8 million. And when we bought it, it had about $560,000 a year in NOI. And it closed exactly 12 months ago, about September 2020. And what was interesting about this portfolio that we call the Tyler Longview portfolio is that we really liked that it had day 1 cash flow and low REIT presence. So that means that, if you go into a primary market like Denver or Austin or downtown Fort Worth, you're going to have a lot of REITs competing. So this is like the Extra Space, the Cube Smart, the Public, and they're going to have a lot more money than you do, and they're going to have it at a lower cost of capital. So they do better advertising than we do. And the market's just generally very crowded in primary markets. So our thesis has always been to invest in the secondary and the tertiary markets, where we're competing primarily against unsophisticated mom and pops. And so we're kind of like the little mini REIT in those markets. And so that really helps us compete at a high level. And so we like the fact that this was a little bit out there. And as COVID kind of played out, we saw sort of our thesis really be validated with the fact that people moved to these tertiary and secondary markets, and we saw a lot of population growth. We like that this portfolio had 90% occupancy. We like that it came from an out-of-state owner. The reason why a seller is selling is important to us because it kind of understands the opportunity that we have. This guy was in California. He's kind of checked out. I think he inherited the properties and just really wasn't paying attention to operations. We love that it had value-add expansion, and we love the economies of scale, meaning that, we had all these, we had 4 properties kind of co-located in one market, which really helped with the overall part. This video, it's got, I don't know if it can play through the computer or not, but I'll just kind of talk about what Tyler said, which is essentially, that we bought this property during COVID. So we went under contract, I think in like the spring or maybe the early summer. So we didn't know what to do because it was like right when COVID started. So we put our team in an RV from Colorado, and they actually drove from Colorado to Texas in an RV, and they did their due diligence like out of a rented RV, like one of those like 1-800-USA ones. And we rented an Airbnb because we wanted to keep our team safe, but we also really wanted to take down this awesome opportunity. So anyway, $8 million was the portfolio again. We gave ourselves 42 days of due diligence, and $75,000 was what we put up for earnest money. That was fully non-refundable or fully refundable up until the point where the due diligence was done. So I love this slide. This is where the money came from. So we raised $4 million of equity from our investors, and we raised $1.3 million of debt from our investors. And we got a bank loan for about $5.7 million from a life insurance company to finance the project. So all in all, $11 million is the amount of money that we stacked to do this investment. And where we spent it was $8 million obviously went to the purchase price. We used 1.3 for the expansion at the Metro, and we improved the existing portfolio, the existing assets by $1 million. We put $300,000 in reserves, and we put $400,000 in project fees for running the portfolio. So what were the terms? Private investor equity was about 7 pref, and we targeted about a 17.9% annual return over a 5-year hold. So just about double your money in 5 years, a little bit shy. And on the construction side for the investor debt, we paid 1 point at closing and then 7% per annum or paid monthly. So that kind of guaranteed debt for our investors. And on the bank loan, again, it was a life insurance company. They leveraged the portfolio about 57%. They gave us about a 3.75% interest rate. And then that was a fully amortizing loan day one at about 25 years. So you may think, okay, I got this big portfolio under contract, or I'm thinking about putting it under contract. Kind of where would you start in feasibility? So the first thing that we did was we looked at the Tyler market, and we basically said, okay, what 2 properties are we buying? Those are the Attic and Highway 155. And then we looked at, what was a comparable vintage to those 2 properties? So we kind of considered those Class B, right? Not Class A. Class A is obviously a lot nicer. So we looked at the Class B averages, and we saw that we had an opportunity to raise rents we were 8% below market on the Attic, and we were about 37% below market on Highway 155. So we saw an opportunity there where if we kind of fixed up the properties, we could raise the rents to the market rates. And in Longview, same thing. We looked at the 2 properties that we were buying in Longview and said, okay, what is the market doing? And so we saw we had a 25% below market rents at one of the properties and 21% below. So we got pretty excited about that. And then we went along and we said, okay, well, what's the demand of these 4 properties? So we do an analysis, and we're not going to go through all the details here, but we figured out that generally at 3 of the 4 properties, we had a surplus of demand. So there was unmet demand in the market, meaning that if somebody came in and built more storage, or if we wanted to build more storage, there would be demand for that new supply to be absorbed. So that's a good thing. And then we ran our due diligence checklist. And Jim, I'm happy to share this with with all of your members at Left Field. I don't know if you have a copy of this, but it's on our website. Actually, you can go onto our Spartan-investors.com, and the checklist is now 740 points long. And it goes over zoning, title, appraisal, survey, site investigation, geotech, environmental, all of these great things. And our team basically huddles, and we use a company called Smartsheet, where we go through and we red light, green light, yellow light, and make sure that all the checklist items are done. And these are the things that we do in our due diligence. And we meet every day as a team for about 15 to 20 minutes just to check in to see where we're at. So our ops team goes and does things, due diligence from the property level. Our construction team goes, our acquisitions teams goes, and then our investor relations teams goes from an investor facing perspective. Those are some of the things we focus on. I won't go through all of them. If you want to download it, it's on our website. But I wanted to kind of dive into financial DD. How do you do financial due diligence on a big portfolio like this? And, one thing that we checked in the rent roll was to make sure that we had the occupancy that was demonstrated in the pro forma. We found that 17% of our customers were delinquent, meaning they weren't paying at all. Some of them were over 180 days delinquent. And if you remember, you can auction off at 30 days. So it really was an opportunity for us to do that. And then when you total the total collections, right, from what they were paying to where you could go with the market, we saw about a 36% below collections in the financials. So we were really stoked about that because the market supported the demand there. We could see that the market was full, so there was no reason why the owner couldn't collect on all the occupants. So overall, we added up all of our numbers and we saw that we could raise rents or raise collections by as much as $447,000 a year in NOI. And then we looked at the physical due diligence. That's one of the subject sites there. You can see they got the swing doors on there, but overall, we do PCRs or property condition reports on all the assets that we buy. We do zoning reports, environmental reports, PCRs, we do surveys, pretty much the whole thing that's in our due diligence checklist. But we found all these things. We found all the failing roofs, outdated retail offices. These doors have all been swapped out now. These are the old swing doors, and in Texas, it's not a very good thing to have because when it's really windy, it's very inconvenient for the customers to kind of open up these closets, and it feels kind of junky and old. And then we found faulty drive aisles and vacant land that we could expand the business on. So all in all, our construction team determined that we're going to have to dump $1 million into fixing up the facilities to bring them up to our standard. And then we looked around the portfolio and said, there's 3 vacant parcels of land, one at the Attic, one at Gilmer Road, and one at the Metro. And I don't know if Jim, if you remember this, but the Attic and Gilmer, we just didn't have enough time to analyze what we could do with those vacant parcels. So we just left it in as significant as upside to the investors that wasn't underwritten. We are planning a self-storage expansion at the top one there at the Attic now, but that's all new. But at the bottom right, the Metro, we figured out that we could expand here. We had matter of right, we had the zoning, it all lined up. So we're moving forward with 25,000 square feet of expansion. And we did an estimate about $1.3 million in construction. And we figured that it would take us about 6 months to build it. And then we'd give ourselves about 20 months to lease up the new units. So by doing that, we would increase the profit by about $108,000 per year in NOI to add on these additional units. So kind of overall, kind of summarizing everything I just talked about, we decided, with the collections, we were only going to pro forma raising collections about $403,000 a year. And we were going to give ourselves the full 60 months to do that in the business plan. So it's going to take us 5 years to do that. Exit cap rates are in self-storage right now. Cap rates, portfolios are trading in the high 4s, low 5 cap rates. On all of our underwriting, we actually show our cap rates getting worse because we don't know where the interest rates are going to go or inflation or anything like that. So we just conservatively underwrite cap rates getting worse. So every month we show the cap rate going up a little bit higher and higher. We put no value on the parcels. We had the planned expansion at Metro, and we planned for heavy customer friction, meaning that we thought a lot of customers would turn over when we got in there and really shook things up. And then we targeted a 5-year hold. And overall, we wanted to improve the portfolio value, $7.5 million over 5 years with cash flow along the way. But then something really exciting happened. There was another property for sale in Longview. And a broker brought this to us and said, hey, you guys are in the Longview market. Any interest in buying this opportunity? We said, absolutely. So purchase price was $1.8 million. And we found that the facility was just completely poorly occupied. I mean, I don't know why it was 45% occupied. Today, it's almost 80% occupied, and we only bought it 5 months ago. But because we saw this, there was great market occupancy. And overall, we said, hey, we can probably, once we stabilize this property, it's going to bring in another $182,000 a year to the portfolio, which adds about $3.2 million of total value to this facility when it's sold. So we kind of huddled and we said, okay, how do we buy this thing? Do we stand up a new syndication and introduce new investors? Do we lump it into the Tyler Longview portfolio? How do we buy this? Because we do single deal syndication. So we'd buy specific properties. We don't do a fund right now or anything like that. So we went round and round and we said, hey, what if we purchased it with 100% debt? What would that do to the portfolio, and where would the debt come from? And we had investors that were very hungry to invest in first position deed of trust, personally guaranteed debt opportunities. And when we did that, we ran up the LTC to about 66%. So we thought, we're really not that leveraged, even with the existing debt that's in place. And we also found out that if we did 100% debt for the acquisition, that we'd have sufficient cash flow to operate. So, and cover the debt service. And so, with the $182,000 NOI increase, we also thought that the facility would be contributing eventually to the cash flow of the overall portfolio. So this is kind of the debt terms that we went out and made with our private investor, and typical 1%, paid at closing 7% interest, and so we bought it. And math and public here isn't my strong suit, so I've already done it. But interest only at 2.2 million. That's about $12,833 a month in expenses. And we found that our pro forma, we were exceeding projections by about $30,000 a month. So we essentially consumed this property for no dilution of equity with our investors. So we could just buy this and do 100% debt. And we gave the private debt investor a lien against I-20. So this added about $3.2 million of portfolio value. And what's really cool is that we just refinanced this property with a local bank. We cashed out the investor that had private debt on it. So now our new interest rate on this property is about 4%. And they also gave us 12 months of interest only. So, the cash flow is only going to get better, and we're really excited about that. So going back to the drawing board, remember I gave this slide about, sources and uses. So just to kind of recap, we got rid of that 5.7 debt. We increased it to 7.9, which increased our total project cost to 13.2. Obviously, our purchase price on the whole portfolio now went up 1.8 million when we bought that additional property. We fixed up that property. We put a new roof on it. We put some new drive aisles in. Cleaned up the office. So we spent about $200K on that. We increased our operating reserves by $100,000, and then we got fees for bringing in that additional project. So how is it going? We have all this business plan, set a year ago, projections to our investors. As you recall, we had about 560,000 NOI when we bought the facilities. And, we said, okay, we're going to raise the rents $403,000 a year by raising the market rents, turning over customers, et cetera. And then we were going to expand at one of the properties that was going to add about 108,000 of NOI. And then, our NOI in 5 years would be about 1.071 million a year. And that, if you're doing the math here, 6.91% cap rate's about a $15.5 million value. So in the first 12 months, we're only 1 year of 5 into the portfolio. How's it going? So we started with 560, and we've already increased collections $345,000 a year. A lot of that due to our ops team and how well storage has been doing. And we are increasing the metro expansion, but now we've got that 5th property adding about $183,000 a year to our NOI. So we're super stoked about that. And so now today, we believe the portfolio would be valued minimally at about 17.3 million, and we're only a year into it, which is awesome. So originally started with 15.5, and we're now at about 17.3. And the reality is that this portfolio sold today probably be closer to a 5 cap if we disposed of it in today's environment. So the last thing I want to talk about is taxes and depreciation. This is a real look at a K1 that we gave our investors earlier this year in March. There's depreciation. So that's depreciation on a 50K investment. It obviously shields taxable income. So our investors got a distribution, but then they got a deduction on their taxes or the shield against their paying taxes on that distribution. And obviously, I'm going to go through like a fun example of depreciation, but consult your CPA because I am not your CPA, nor am I a CPA. So always do your due diligence on working with your professionals on that. So how does depreciation work? How do we get a $1.6 million write-off in the first year? And no one's ever really explained this all that well to me. So I went through and did a really fun example. So how does a $50,000 investor lose $10,778 in the first year? Here we go. So remember the purchase price was 8 million, right? So what you do is you call a cost segregation study out to the cost segregation engineer to the property. We use Madison specs, and they're going to determine a couple of things. They're going to say, okay, you got an $8 million purchase price, and they're going to say, we're going to allocate your stuff into 4 buckets. 1, land. How much is the land all worth together? And they're going to look at tax assessments and things like that. But they determined it was $800,000. You cannot depreciate land, so that gets thrown out the window. Then they say, okay, how much 5-year property do you have here? Computers, things that are just, they depreciate real fast, like in a residential, that'd be like appliances, landscaping, etc. So he said, okay, we got 644,000 of 5-year property. And then the 15-year property is your land improvements. And they determined that about 922 of value. They take a bunch of pictures and do a study, and they look at the composite of the buildings and things like that. And then they said, okay, the rest of the portfolio goes into what's called improvements, which is the buildings. So they determined that that value was about 5.6. And so all in all, they totaled it up to $8 million, right? That's what your purchase price is. So then they have bonus depreciation, which basically means that you can take all the 5-year property and 15-year property, and you can write it off in the first year. So in the first year, we could write off about 1.566 for bonus depreciation. And then we say, okay, but don't forget about that 39-year property, because you can depreciate that over 39 years. So you divide the 5.6 million by 39, and that gives you about 144 a year. And then you add those two numbers together, that's your depreciation in year 1. And I know the picture is a little bit off, but and then you say, okay, for me as an investor, how do I get a write-off? Well, you multiply it by your ownership and you get your loss. And that's how depreciation trickles down. So it's something we do at Spartan. We do quarterly investment statements. We like to really communicate well with our investors on what the business plan said it was going to do and then where it actually is. So this is our performance. Obviously, these charts are a little bit dated. I haven't updated them, but the dashed line represents our pro forma of revenue. And then the solid line is our actual revenue. So we do this for revenue, expenses. We do this for your distribution. So right now we're clipping about a 9% per annum coupon, and we distribute our investor distributions monthly. And then we also look at NOI. If you'd like to join our newsletter, there it is. And our website, spartan-investor.com. These, Lauren, Ted, and myself are in charge of the investor relations team. I think gentleman before Chris was talking about, he talked to Ted, and that's all I have for questions.
Excellent. Well, thank you, Ryan. That was fantastic. I really enjoyed that, especially since I am an investor in the Longview. That was some great information.
Yeah, now you're briefed. You know exactly what's going on. So
yeah, exactly. That was awesome. So I'm going to open it up for questions, and I think the easiest way to do that, can you stop the share? That way I can get the whole screen so I can see people better, because I'm not very good at looking at that with the screen.
Yeah, let me see here. Perfect. Here we go.
Yeah, great. And then I will have, if you want to ask a question, maybe go ahead and unmute. And that way I'll know you're ready to ask a question. And if everyone doesn't mind, I will start with the question is, so you've already hit your goals, the 5-year goals on a project like this. So what do you think about, if someone comes and offers you a sale, are you going to sell? And then kind of an aside there is, how do you decide to exit? Because you're doing all this branding, the free up storage, right? So when you sell it, then do you take the free up off, or do you sell it with the, I'm kind of confused about that. I don't know if that's a question or not.
No, that's a lot to unpack, and I love that question. One thing that we're doing is we're building a portfolio, and we actually sat down with some of the larger institutional buyers, and they, we have just shy of 400 million of assets under management storage, and they said, hey, come talk to us when you have $1 billion, and when you have $1 billion. They want to come in and write a big check for between 3 and 4 cap rate on an exit. So, we still have an expansion at Metro to complete. We still have an expansion at the Attic to complete. We still have those other parcels that we can redevelop. So we still have a lot of value to add to those properties. And so our overall strategy is to probably exit our portfolio to a larger buyer in 2 to 3 years. which, again, we applied a 6.91% cap rate to this portfolio. The reality is that if it transacts in a larger portfolio with more assets, you're probably going to see 200 to maybe 250 basis point cap rate compression. So you're going to get a lot more value out of the sale if you bundle this with a larger portfolio. So a lot of things we can do there. The other question was about free up, which it's really up to the buyer. We buy portfolios that have branding on them, and we just take it off and put our branding on it. So it really will come down to what the buyer ultimately negotiates. To buy it with the branding in place, to keep our management in place, or to strip it off and put their own branding on the property.
Okay, great. Are there other questions for Ryan? You can either wave at me or unmute and I'll try to find you. Or you can just start shouting.
Hey, Ryan, this is Shad. Can you hear me okay?
Yeah.
So when you do exit, what is this? And I came in a little bit late, so you may have said this. What is the split between the GP and the LP, aside from the cumulative pref?
Yeah, I don't know what that one is off the top of my head. But we range anywhere from, typically like 70-30, 60-40, something like that. Okay. I don't know what that one was off the top of my head though.
And have any of your deals, I know you said you had closed some deals previously, have you closed or sold any self-storage deals to date, or is these all previous condo deals?
Yeah, so most are residential, 90% of them. One was a self-storage that we consolidated to do a new portfolio. We cashed out all our investors. So one self-storage transaction.
Okay. Thank you.
You're welcome.
Other questions?
Ron, I see the airplane. Ron Thomas, I see the airplanes. Do you fly as well? Sorry.
I just retired. I was the vice president of safety for American Airlines, and I flew the 320 family.
Oh, nice. Okay. Delta. Boeing guy. 76, 75, and 73. I did some work for the FAA too for a bit, so that's great. In Fuqua.
All right. Anybody else?
Hey, Ryan, can you hear me?
Yeah.
Yeah, no, just a quick question on, so you guys focus on secondary and tertiary markets, and I would assume U-Haul is in those markets, PSA and SmartCube and others are not in those markets?
Yeah, so in the tertiary markets, typically you won't see Extra Space, CubeSmart, StoreQuest, etc. In the tertiary markets, correct. I mean, sometimes they are. There'll be like one or two, but not like if you go to Vegas or you go to Denver, or if you go to Austin, every single self-storage you drive by is the 3-story, beautiful, Extra Space, public, and those are very difficult to compete with. So we try to stay out of those more primary markets.
And have you seen the conversion that U-Haul has done on Kmart stores and so on, or?
Yeah. Oh, absolutely. We actually
is that something you? Okay, sorry. Go ahead.
Yeah, we actually own a facility that was formerly a Macy's that was converted into self-storage.
Okay.
Yep.
Good. Thanks.
Yeah, no problem.
So Ryan, hi, it's Sami. Wanted to ask you about your pipeline and what do you see in the next several months? Kind of Q4 this year and Q1 next year.
Yeah, so we have a 8-property portfolio in Georgia and Tennessee under contract that will close in Q4. And we're just finishing up the purchase of the DFW portfolio that will close actually later this week. It's an 18-property portfolio. And then we're buying a couple of assets, one in Georgia and then one in Tyler, Texas, that will wrap up later in October. So we've got a great pipeline right now. It's pretty incredible. So yeah, we're seeing a few acquisitions in Q4 already kind of lining up and planned. Jim, that Southeast portfolio that's under contract now for Q4, a lot of it kind of mirrors the existing properties that we just closed in the Southeast. So there'll be a lot more economies of scale with hiring an area manager versus having like a manager at every property, because we highly automate all these facilities. So very good pipeline. To answer your question. Yeah.
Thank you.
Welcome.
Hey, Ryan, so you mentioned like Southeast portfolio, that kind of thing, but you mentioned that you don't do funds. Am I missing something there? Or so is it multiple properties and then?
Yes.
Okay.
Yeah, so we don't do a fund. A fund would kind of be like, you know, hey, the fund can target these types of properties, and we just sort of, as they come up, we can close them and buy them and sort of always be, you know, kind of consistently be raising. But with the portfolio acquisitions, it's a very limited scope. It's these 10 properties. It's these, you know, these assets in these markets. It's kind of limited in that regard.
Okay. So all these assets are already under contract, and then you get the investors, so they know exactly what they're going to be investing in.
Exactly. Yes.
Okay.
It's a closed single asset investment. Correct.
Okay. And then you mentioned the exit strategy, I guess the big exit strategy. If you get $1 billion under management, if that's going to be in 2 or 3 years, what's your plan after that?
Well, you know, one strategy would be I mean, we'd probably do it again. You know, to answer your question, I mean, if we went full cycle, you know, we have a great team. We don't want to shut down the team and build it all over from scratch, but we could kind of go back into the market and sort of do it again with storage, or look at what we did, you know, 5 years ago, which is, you know, hey, what asset class should we be looking at? So we might reevaluate which asset class we go into, or if storage still has this tailwind that it has now, you know, we would probably go back into storage. But storage is in a perfect sweet spot right now. There's a lot of funds out there that they have $2 billion to deploy, and they've only been able to acquire 100 million. There's a very limited supply of storage. So we see the next 2 to 3 years to be kind of the prime opportunity to acquire at our value, expand our properties, stabilize them, and then exit them in 2 to 3 years. Beyond that, you know, we just have to reevaluate the market and see if storage is the right asset class to get into. So, because we've done mobile home park development, we've done RV parks, done condo development. So you know, we're not adverse to switching asset classes in a few years if it made sense.
And are your minimums 50,000? I don't know if you said that or not.
Yes.
Okay. Thank you.
Welcome.
Ryan, this is VD actually. I have a question. In the case you don't have a specific exit, or the exit does not take place, at that point, what are investors looking at in terms of cash on cash return, in terms of how these properties cash flow?
Yeah, I would say, you know, it depends on the deal, right? But I would say that we're showing peak cash yield anywhere from 10 to 12% when these business plans mature. You know, that again, it depends on the specific offering, but you know, if it didn't sell, you know, we could see, you know, peak cash yield, you know, somewhere between 10 and 12%. We have one of the assets that's been in our portfolio for about 2.5 years. One of the little longer ones is clipping about 12.3% per annum every month. And that facility is probably the first facility that we're taking full value add, or we've added on the units, we've leased up the property, and it's probably ripe for a refinance to return 100% of our investor capital, or it's probably the first property that's in that stabilized point where it's ready to be sold because the equity is you know, it's built up in that property. So yeah, I would say 10 to 12% would be pretty typical.
Thank you.
Welcome.
Any other questions?
Yeah, good questions.
I got one more for you, Ryan. We have a deal analyzer that we use in our community, and it's really, you know, focused on multifamily. But can you give us like 2 or 3 metrics that you would look at, not as if I'm going to underwrite the property from scratch,
Yeah.
but as a passive investor, I'm looking to invest in your deal. What are a couple things I can look at to check to make sure that this deal kind of, you know, pencils out?
Yeah, so the first thing I would look at is how, like, I look at your annual P&L, I would look at years 1 through 5, and I would notate how much the revenue has increased year over year. You know, what percentage? So from year 1 to year 2, how much did revenue go up and why? You know, gross revenue. And then, you know, once I determine that percentage, I would try to get a breakdown as to why that revenue is increasing. Is it because they're deploying millions of dollars in initial improvements to bring the facilities up to a new vintage, maybe making it from a C class to a B class property. And then that would match the market rents of the B class properties. Or is it coming from an expansion of the facility, adding on additional units, or is the operator banking on market rate rent increases? And what I mean by that is, let's say the market's $80 on the average, and they're thinking that it's going to go up to 85. And I would just be really aware of how much is the operator banking on current existing conditions and just bringing things to market versus how much is the operator banking on taking the market going up. So usually over a 5-year period, we only show rents going up, like the market actually going up about 7% in the totality of a 5-year hold. Anything more than that, I think, is a little bit aggressive. I know in 1 year it went up 12%, but that was kind of an anomaly. So we like to see, how is that revenue increasing year over year and why? So I would really unpack that. That would be the first thing I'd look at. On the expense side, I would look at property taxes. When we buy these assets, they get reassessed, right? And they go up, right? They don't go down. So especially in Texas, where Texas is a non-disclosure state, meaning you don't have to disclose the sales price to the county in Texas. However, there's people at the county trying to figure out what you paid, and they're trying to jack up your taxes because you get hammered in Texas with property taxes. You think that's a very tax-friendly state, but the reality is they come after you for blood in your property taxes. So I would look at property taxes. How have they assessed that? Are they doubling it? Because we usually show 100% increase in property taxes based on the mill levy rate in that market. And the last thing I would look at on the expense side is insurance. Climate change, whatever you believe, whatever you don't believe, insurance expenses are on the rise because the underwriters are having to factor in that there's just a lot more weather events, and their premiums are going up. So when you're looking at expense ratio, property taxes and insurance are going to be your two biggest variables. And I would probably want to see in storage at least a 40% EGI. So for every dollar that you're earning, I would want to see a 40-cent expense before debt service. So that would be kind of my first sort of blush. And then always, I always say, okay, what's the cap rate, going in? What's the cap rate at the exit? And so, because obviously, I can make anything look good if I just dial down the cap rate, Yeah. I can just, the market rents are going to go up 10% every year, and the cap rate's going to go down 50 basis points by the 5-year hold, right? And then that looks great. But the reality is you really can't be a predictor of cap rate. And that's just one thing that I would make sure that the operator has kind of assessed. Is that helpful? I don't know. That's kind of
Yeah, that's great. Thank you very much.
Yeah, you're welcome.
So we're a little bit over 8. So this was fantastic, Ryan. We really appreciate it. And what we're going to do next, first, 2 quick reminders. We have a meeting next week for the infielders on Bitcoin. If you're not an infielder, sign up if you want to join. And our next meeting is October, 25th, I believe, the 4th Monday of October with Jameson Lett. We're going to talk life insurance, cash values. So what we're going to do now is break into kind of networking rooms. I realize this isn't perfect being on Zoom, but this is just kind of a chance to try to get to know each other. So we have a few hosts, and I see some people are dropping out, so it'll take me a minute to kind of shuffle the rooms a little bit. And we are going to go for a hard stop of about 8:20 because I have another meeting, and when I turn off Zoom, I found out that everyone gets kicked out. So I know some of you have agreed to be hosts, so I appreciate that, but everyone dropped out of a couple of groups. So give me a second to shuffle these. I'm gonna stop the recording.